Let's get some shareholder reaction to these Morgan Stanley numbers, plus those from Wells Fargo. Scott Richter is a portfolio manager at Fifth Third Asset Management, joining us from his offices in Cleveland. Scott, thanks for your time this morning. Let's start with Morgan Stanley. A disappointment here on both the top and bottom line. We got that compensation number, but clearly one of the big takeaways, the revenue story from Wall Street, just not what it was last quarter.
Yes, good morning, John. No, it wasn't. Morgan came in a little bit light, but I think one has to focus on the long term for Morgan Stanley. Whereas sales and trading looked a little light in this quarter, I think that was expected, maybe not to the degree that it manifested, but fixed income got a lot tighter. There was a lot more competition. The spreads narrowed, and the equity trading dried up with hedge funds, going to the sidelines, and the rest of the managers kind of just taking a break. So I don't think it was unexpected, but going forward, looking at the economy and the economy getting some traction, I think sales and trading could have a robust 2010, and when you look at underwriting and investment banking, Morgan Stanley has taken this opportunity in the chaos to move right up the list. So I think that's a big opportunity for them.
So you're saying investors aren't going to look at this as Morgan Stanley doing some hiring of traders late in the game and missing the boat, that actually that's going to benefit them in 2010?
Well, you want to hire them when you need them. I mean, the same is true of the wealth management business. Should assets continue to gain value, the Smith-Barney joint venture looks like it could bear some fruit in 2010 as well.
Scott, very quickly, you own more shares, or at least Fifth Third does, of Wells Fargo. Those numbers coming in better than expected. Let me get your quick reaction. I've got to look at the details. I honestly haven't seen the press release, but based on the top line, it looks like they had a beat both on revenue and earnings. And I think the issue there with Wells is their exposure, their dramatic exposure to the real estate and mortgage market. So to the extent that things are better there, that provisions and write-offs and non-performings have stopped getting worse, I think that's all a positive thing. And with the economy once again getting some traction, that could actually be a positive for them. They have a very, very nice national franchise, banking franchise. So I think that's a plus. All right, Scott, appreciate your thoughts. Scott Richter, portfolio manager at Fifth Third Asset Management.